Welcome to another explainer, everyone. Let's be real for a second. If you've ever bought into one of those massive green breakout candles, feeling that absolute crushing fear of missing out, only to watch the price instantly reverse and trap you, well, you are definitely not alone. Honestly, it's probably the single most common pain point in trading. You think you're riding the momentum, right? But instead, you're actually buying exactly where the smart money is selling. So today, we're going to completely rebuild how you look at your charts. We're breaking down the actual mechanics of the market auction, and I'm going to give you a structured way to read the market like a pro using something called the volume profile. Think about it like this. Picture a pilot sitting down in the cockpit of a commercial 747. They're surrounded by dozens of gauges, dials, and data points. They don't just, look out the window and guess if they're flying straight. Yet, that is exactly what you're doing if you trade naked price action without advanced volume gauges. You're literally flying a commercial jet blindfolded. Sure, you might see the price moving, but you have zero visibility into where the actual fuel of the market, the trading volume, is situated. All right, so here's our exact roadmap for this explainer. First, trading blind versus flying safely. Second, time versus price volume. Third, the anatomy of the profile. Fourth, the psychology of nodes. Fifth, how to plot profiles. And finally, building your trading strategy. Let's kick things off with part 1, trading blind versus flying safely, and part 2, time versus price volume. So there is a massive paradigm shift we need to talk about. Most of us are totally used to that traditional volume histogram running along the bottom of the screen. But here's the thing, that is time-based volume. It just tells you that at, say, 9:30 a.m. a whole lot of trading happened. But honestly, who cares when it happened if you have no idea where it happened? The volume profile takes that data and flips it onto the side of your chart. It calculates volume by price. It reveals the exact price level where the real money is trapped, where the deepest interest lies, and where the biggest transactions went down. Basically, time volume tells you a party happened, but price volume gives you the exact address. Moving right along to section 3, the anatomy of the profile. Once you've got this profile on the side of your screen, it's basically shouting 3 crucial things at you. First up is the point of control, or POC. Visually, you'll usually see this as a stark red or white line cutting right through the thickest part of the profile. The POC is the absolute center of gravity for a price move. It's the single price level where the ultimate fight between buyers and sellers took place, where the absolute most volume was transacted. And because of that, it acts as a massive magnet for future price action. It becomes a premier support or resistance zone. Now, surrounding that POC, you've got high volume nodes, or HVNs. Think of these as the big wide peaks on that sideways histogram. An HVN represents a broader price zone of agreed upon fair value. This is where the market is totally happy to just rotate and do business. It's a zone of balance, really high participant interest, and usually heavy consolidation. When price enters an HVN, it actually tends to get stuck there, kind of bouncing up and down as buyers and sellers duke it out. Contrast that with the low volume node, the LVN. These are those deep, empty valleys on the profile. When price enters an LVN, there's just no interest, no liquidity, and absolutely no agreement on fair value. Because of that, price sprints through it. It acts like a vacuum. The market rapidly shifts into price discovery mode, throwing out these massive, fast candlesticks, just desperately looking for the next area of balance. Let's dive into section 4, the psychology of nodes. To really understand why the market behaves this way, we have to look at one absolutely crucial statistic. Roughly 68 to 70% of all trading volume occurs strictly within these high-volume value areas. Think about that for a second. Nearly 3/4 of all the money in the market is clustered in very specific, easily identifiable price zones. And honestly, this perfectly explains the psychology behind that FOMO we talked about earlier. Inside that high-volume node, where 70% of the volume is, an intense fight is happening. Big players, small players, everyone's in there exchanging contracts. Eventually, someone wins. When the buyers or sellers finally win that fight, the price breaks out of the HVN and enters a low-volume node. That resulting massive fast candle, that's just the winner's sprint through an area with zero resistance. So when you get FOMO and you buy that massive green breakout candle, you are buying the winner's sprint in an LVN, right at the exact moment the big players are looking to take profit and reverse the price back to the point of control. You are literally buying into the void. Okay, let's get practical with section 5, how to plot profiles. Professionals have a few main ways they pull this data, depending on their style. The most precise method is the fixed range profile. This is where you manually tell the tool exactly which battle you want to analyze. Say you're in a clear uptrend. You just identify the absolute swing low of that move, click your tool, and drag it all the way up to the recent swing high. The software instantly calculates all the volume traded within that specific push. It reveals exactly where the bulk of the interest is, letting you easily map out the point of control for that specific leg of action. Then we have the session profile, which day traders absolutely love. You just turn on session breaks in your settings, anchor the profile from the moment the market opens, say 9:15 a.m. for stocks or 6 p.m. for futures, and drag it to the close. What makes this so incredibly powerful is looking back at yesterday's session. If price never returned to yesterday's point of control, we call that a naked POC. And let me tell you, those naked POCs act as highly magnetic, excellent targets for today's price action. Now, for a macro perspective, we use the composite profile. By dragging the fixed range tool over weeks or even months of data, you bundle all that trading activity together into one big picture. This reveals massive structural levels. For instance, in our sources, looking back months at assets like Bitcoin or gold, you might find a massive composite POC sitting perfectly at, say, the 24,800 level. These high time frame structural levels act like absolute brick walls in the market. They are the best places to plan out your big swing trades. Finally, Section 6. Building your trading strategy. So we've got the mechanics and we've got the psychology. Let's pull it all together. First, a quick reality check. The volume profile is a map. It is not a standalone magic bullet. You don't just blindly buy a point of control and hope for the best. To create a true A+ setup, you have to layer this map with structural confluence tools. Professionals marry the volume profile with tools like VWAP and its standard deviations to measure momentum. They use the 9 and 20 exponential moving averages, basic trend lines, or even smart money concepts. When a volume profile POC lines up perfectly with a 20 EMA and a key structural trend line, now that is a high probability trade location. So, distilling everything we've learned down, here is your core actionable takeaway. The novice mistake is giving into the fear of missing out. It's seeing price launch into a low volume node and buying the very tip of that spike, just hoping it continues into the void. The pro move? The pro move is identifying the breakout, doing absolutely nothing, and waiting patiently. You wait for the price to exhaust itself and retest the point of control or the high volume node, returning to fair value where 70% of the volume actually resides. You buy the retest of value, not the sprint into the void. By just switching your focus from when volume happens to exactly where it happens, you've basically just flipped the lights on in that 747 cockpit. You now have a framework to see exactly where the market accepts value and where it rejects it. So the only question left for you is this. Are you going to keep blindly buying breakouts in the dark? Or are you going to use these gauges, map your high volume nodes, and finally start trading the actual auction? Thanks for hanging out with me for this explainer, everyone.